Last week, Kyle in California called in to ask about a company called Vecto IQ. It's a special purpose acquisition vehicle that's merging with Nikola Motor, the electric truck startup. The deal happens tomorrow. Oh, man, this is a smoking red-hot stock that's exploded higher in recent weeks. So I promised to do a little more homework and then circle back to it. And, boy, I know people are really interested in this thing. It turns out there's more going on here than just one deal. Lately, we've seen a host of these special purpose acquisition vehicles, they call them SPACs, catch fire in a way that I find, let's just say I find them borderline disturbing. It feels so frothy. When you see these super speculative stocks exploding higher, that's not a good sign. It means the rally might be reaching the end of its trajectory. I know if you're in it, you don't want to hear that, but I'm just speaking historically, okay? Before we get into the ramifications, though, you need to understand what's going on here. So let's start with the special purpose acquisition vehicle. What the heck does that mean? These are basically piles of money that list on a public exchange in order to make acquisitions. I want you to consider them like blank checks. Usually it takes a year and a half, 2 years before they even do a deal, at which point shareholders are really just betting on the executive's ability to spot a bargain. If they don't find anything worth buying, they dissolve themselves. Investors get their money back. In recent years, we've seen more and more of these special purpose acquisition vehicle IPOs. 2014, they raised less than $2 billion in total. Last year, they raised $13.5 billion, in part because there's just so much cash floating around the system, or at least there was before the March meltdown. Now, I don't have anything against special purpose acquisition vehicles as a concept. But you have to understand that this business model has changed. In the old days, SPACs were typically roll-ups. They'd make a series of smaller acquisitions to build a dominant position in an entire industry. Okay, I'm not crazy about roll-ups, but it makes some sense to me. Lately, though, we've seen something different, where they do a big, flashy, high-profile merger with a larger company, usually one that's structured in an incredibly complex way. Let's call it opaque. Often it's done as a way for startups to list their stocks publicly without going through the IPO process. Now, this is what happened with that thing, Vecto IQ, Nikola Motor deal in the end. And we've seen other examples. Yeah, Virgin Galactic was one of these. So is DraftKings. Now, we've seen a pattern with some of these flashier SPAC names. Their stocks tend to spike going into the merger, and then immediately after. But past experience tells us these spikes are temporary. And that's why I'm getting nervous when I see this Vecto IQ and the DraftKings roaring here. So let me give you some examples. A few years ago, a SPAC called Platform Specialty Products came public, and that had the goal of rolling up the chemical space. Platform is now known as Element Solutions, but you can see the trajectory plain and simple. The stock tripled from 10 to 30 in 2014 as investors got excited about their game plan. That's like Vecto IQ, okay? And then it collapsed back to the mid-teens. These days, it's borderline irrelevant. Second, there's Nomad Foods. Now, this is one of the most successful special purpose acquisition vehicles around. But even Nomad had a huge and unsustainable spike after the stock came public in 2015. Early on, the stock surged up to 22 before collapsing back to the mid-teens. Since then, Nomad's worked its way back to the 20s, but it's taken years, and you were better off buying this one at the bottom than at the top. The best example, though, is Virgin Galactic. Okay, this is space. Late last year, a SPAC called Social Capital Hedosophia merged with Richard Branson's space tourism company, Virgin Galactic. This is one of the most speculative stocks I've ever seen, as space tourism is a long way from being a profitable industry. However, when President Trump reached a preliminary trade deal with China last December, a lot of super speculative stocks caught fire. And they kept running over the course of January and February until they ran headfirst into Covid-19. At the time, I warned you that the strength in Virgin Galactic was a sign of froth. Sure enough, the stock came plummeting back to earth along with the rest of the market. It's never really recovered, although I know people always get excited about it, and I don't blame them. This is a bull market in exciting stocks. These days, we've forgotten about Virgin Galactic. Instead, speculators have moved on to DraftKings, which came public via merger with a special purpose acquisition vehicle called Diamond Eagle in April. When that deal happened, the stock had already run from 10 to 17. Since then, DraftKings has kept soaring. You know, it's peaked at almost 45 yesterday before pulling back from its highs. It's now at $40. You should know I really like DraftKings, the business. I totally understand the excitement for the sports gambling play as more and more leagues announce that they're reopening. I saw basketball opening in July. Well, wouldn't that be great for these guys? But, man, this thing has gotten way too hot for me. If you bought DraftKings after we last spoke to the CEO less than 3 weeks ago, you're nearly up 40% here. You know what you got to do when you're up that quickly? Come on, this is what you do. You ka-ching at least part of your position. You know what that's called? It's called being responsible. DraftKings has a terrific regional and national online gambling story, but these initial SPAC spikes tend to be short-lived. So do me a favor and take something off the table, though not the whole position, because I still like the story. And people could say, well, if you still like the story, why not take it off? Well, because I can be wrong. Finally, there's VectoIQ, the SPAC I was asked about that's merging with Nikola Motor tomorrow. Nikola makes hydrogen fuel cell powered trucks. People love hydrogen fuel cells. I cannot tell you how many speculators have been burned over the years by betting on hydrogen fuel cells. Let's just say a lot. When this merger was announced in March, VectoIQ was trading at $10, roughly the value of the cash it was sitting on. That's when you had to buy it. Since then, the deal was announced, so the stock has surged to $34. That's even bigger than the pre-deal run-up in DraftKings. Tomorrow, VectoIQ becomes Nikola Motor. And the problem here is that Nikola Motor is impossible to value. They're working on an electric truck for next year and a hydrogen fuel cell powered truck for 2023, as well as the infrastructure that will be needed to make fuel cells viable. They've got a cool model. It's software as it's just one of those businesses, SAA. Let's put it this way. You don't just buy the truck, you get the whole shooting match, okay? And the software as a service has even come to trucks. Now, Nikola's got a pre-order book of $10 billion. So if they can deliver on their plans, well, the business is worth a massive amount of money. And that's what the promoters are counting on you believing. The obvious comparison here is Tesla. They're in an adjacent business. They're named after the same guy. Not necessarily buddies. Plus, the founder and CEO, Trevor Milton, is a colorful, boisterous guy, not unlike Elon Musk. And I like those kinds of guys. I do. I like them. But how do you value a company that's not selling anything at all until next year when their main business won't even get off the ground until 2023? Like most fuel cell stocks, Nikola Motor will trade on the headlines. And that only takes you so far. So when you invest in hydrogen fuel cell play, you're betting on a dream. That's a pretty high-risk proposition. But everybody has a right to dream. Honestly, though, the thing that really gives me pause here is very simple. When a SPAC makes a big acquisition, they usually include an implied enterprise value for the combined entity to figure out who gets what stake in the business. For both DraftKings and Nikola Motor, the implied enterprise value was roughly $3.3 billion. Yet both of these companies are now worth over $10 billion. Hey, what's a triple among friends? Now, again, I like DraftKings. I'd be a buyer at lower levels. But the bottom line, you need to be careful with these red-hot special-purpose acquisition vehicles that explode higher right out of the gate. The incredible strength in VectoIQ ahead of the Nikola Motor deal, hey, it makes me a tad concerned, call me worried, that the market's getting out of control, not just this one. Just like when Virgin Galactic shot into the stratosphere in February. It's not a great sign. If history is any guide, Nikola should be able to roar after the deal closes. Judging by my Nikola-dominated Twitter feed, yep, I'm betting this one will jump big. But eventually, I expect the stock will give up most of these gains as we don't have any real sales here, let alone earnings. It's a blank check made out to a bunch of big thinkers. Fine, not yet bankable. Oh, and if it ends up getting hit, please blame me. I mean, don't blame me. The fault is not in this star, Jimmy the Chill. Oh, it's actually in yourselves. People will hate me for that. Can we cut that negative stuff out so everyone loves me? Oops, sorry, that's not the way it works on TV. How about Dylan in Virginia? Dylan.
How you doing, Jim?
Dylan, I'm doing well.
I'm calling about Resideo Technologies, ticker REZI. They're a former Honeywell subsidiary that is a leader in supplying cloud infrastructure security tech. The stock has lost a lot of value since Honeywell spun it off, but trades at a price of sales around 0.2, while the industry trades at a 2. Now, the CEO of ADT, one of the biggest clients, said in the earnings call they've witnessed a significantly higher sales conversion rate, but the strong intent to buy security.
Okay, so well, look, Honeywell spun it off. Honeywell spun it off, and I told you to buy Honeywell, not these guys. This thing is down so low that I wouldn't bet against it. It's down 32%. It's kind of an interesting cats and dogs stock here for this particular moment. I'm actually going to say that it's right. I hated it all the way down, so I actually have the, I've got the smart sheet to, oh, sorry, that's down 10. I've got the ability to be able to say I think it's right. I like your thinking, Dylan. I think you got horse sense. I want you to be a tad careful of SPACs that explode higher right out of the gate. And it makes me fear that some of this market, actually a lot of it after today, is a bit out of control.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Kramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.